The beginning of October has not been great for the S&P. We see red pretty much right across the board, although you could argue the reason for this, as we have some breaking news, is that Iran launches missiles into Israel, and therefore the S&P itself is taking a turn for the worse. Now, in today's episode, we want to talk about Pfizer, which we believe to be one of the best opportunities in the market, with a yield, as we are about to show you, is near the 6% point. Now, we're going to touch upon a few reasons why we like this, look at our valuation, as well as some very intricate detail. And the first thing that we do want to point out is that the US money market funds, so a lot of money that is sitting on the sideline, continues to increase at a very rapid rate. Now, we understand this information is a little bit outdated, but from other sources that we have seen, this does continue to rise. And that is why we do like this company, not only because the yield is very high, but as the US Fed does start to decrease those interest rates, money on the sidelines will start to pour into companies like Pfizer with very high yields. Now, we also want to touch upon how they have started to look a little bit better from their previous results where they were struggling post-COVID, but in their latest earnings, we do in fact note they did beat. They also hiked their full year outlook, as well as looking forwards to making some cuts. Now, in terms of the actual earnings and how they performed, what we can see in terms of the earnings per share, well, we get 60 cents, much higher than the market expectation of 46 cents, as well as the revenue looking very strong, 13.28 billion versus the 12.96 expected. On top of that, what we can also see is that they are expecting by the end of this year to have delivered at least 4 billion in savings, and they've also now announced that they're looking to do an additional 1.5 billion savings by 2027. Now, one thing with companies in this industry, we do always like to take a look at their pipeline, understand what they have going through the process, and we note that they have around 113 candidates, which they do believe will make some potential breakthroughs. Now, we're not going to go into the intricacies of these, what they are, but one thing that we will point out is that there are a few different phases. You have phase 1, phase 2, phase 3, as well as registration, and each one of these delivery projects need to go through the different phases before they can essentially be out there and accessible to the public. What is good to note though, when we have been following Pfizer, they have a lot in the pipeline, and we do believe, as we will discuss later, their revenue will start to increase. Now, what is very interesting as well, not something that is talked upon a lot, that Pfizer did very recently acquire Seagen, and why we like this company is because in fact they are a leading oncology company and is expected to help, especially for those people with cancer. Now, we note essentially they're a biotech company and they do develop, commercialize transformative cancer medicines, and ultimately not only here looking at a shareholder perspective, but it does look like if they can bring this into the real world and really help the public, then this could also be a very good move moving forwards. One thing that's also very important to understand with any company that you want to give your hard-earned money to is how do they essentially enhance your shareholder value, and a few ways that Pfizer has been able to do this. As we can see, they have returned 4.8 billion to shareholders through the dividend. We're going to touch upon the actual growth shortly, but a very nice yield, as we mentioned, near the 6%. On top of that, they are starting to pay down some of their debt, which is always a good sign in terms of strengthening the balance sheet. We also want to see, especially for companies in this industry, that they are putting some of that money into research and development. As we said, we want to see a growing pipeline, which does in turn come out to be very good income streams moving forwards. Now, whilst they don't do this, at least they do talk about it in their investment slide, that they have no current plans for any share buybacks in 2024. Hopefully, moving forwards though, we can see this start to become something that they do implement. Always a nice added bonus, returning that excess cash. We also want to point out, we did touch upon that they did in that latest quarter raise their 2024 range for the revenue, previously sitting around 58.5 to 61.5, and whilst it is a fairly trivial increase, still nonetheless always good to see from a company that has been struggling that they are increasing their expectations in terms of the revenue. Now, this isn't just specific to the revenue, we also note their EPS, the earnings per share, going from 215 to 235 to now lifting that up slightly to 245 to 265. Now, before we continue, we want to let you know that we have released our latest free weekly article. We drop one every single Monday where we talk about what's happened over the last few days in the market, and for example, in the more recent one, we talk about 3 stocks that we are looking to buy this month, so grab that by clicking on the pinned comment below where you can sign up and read straight away. On top of that, we have now released our 36 undervalued stocks for your consideration in the month of October, where we go through each one in quite some detail, talk about those as well that sit within our own portfolio, and as an added little bonus, you can also grab our 22 dividend stocks with the most upside according to Wall Street. So don't forget, click below, sign up and read straight away. Now going back to Pfizer, we do note it is down around 16% over the last 12 months. Over the last 10 years, pretty much flat, down around 2%. As always, will depend at which point you did buy shares. If you did reinvest those dividends, it would be marginally higher. And we can see all-time highs back end of 2021 at $59. Now currently it is trading in the mid to lower end of the 52-week range. We have a double buy signal from Seeking Alpha and Wall Street, a hold from Quant, as we already touched upon the yield 5.8% and a forward PE around 10.91. Now we also like to look at other information in terms of inside and institutional movement, starting off with insider 0.06% ownership, $79,000 worth of buys over the last year. Over the same time period, no insider selling, which is ultimately a good sign, but as always we do tend to focus on insider buying, but as we can see that insider buy didn't come until Q4 of 2023, so all of this information we would say is pretty irrelevant, not that timely at all, and just if you do want to see in terms of buys and sells, you have to go back all the way to the 15th of December to see the director buy around 3,000 shares. Now we do know US Congress members buys and sells, but not something we do typically focus on unless it is the infamous Nancy Pelosi. Now likewise, we want to do the same analysis for institutional ownership, 68%, around 9.4 billion worth of sales over the last year, with marginally less buys at 9.02, and when we do take a look at the more recent quarter, we see a little bit of selling, 200,000, no buys. With the previous quarter, we see the opposite. So you could say overall institutions pretty much undecided over the last year, roughly the same amount of buys as sales, but as always, please do your own due diligence, don't copy institutions or insiders. Now we're also going to look at some of their metrics. First thing to point out, dividend safety score sits at 75. We have this reasonable valuation, which we can discuss, and a very mediocre increase of 2.4% in December. As always, you want to be aiming for at least 4% just to keep up in line with inflation. Now, it was reaffirmed in August, in fact, just a few months ago, that it was safe, which ultimately means a dividend cut is unlikely. Now, how did Pfizer perform in the last recession? Well, Great Recession 07-09, they in fact cut the dividend, so not great at all. Didn't even at least maintain it. They had above average growth, -6%. As we can see, S&P was around -12, and they also marginally outperformed the S&P recession return, -45. S&P itself coming in at -55. Now, as we said, trivial increase in December last year. At least over the last 5 years, they've increased it in line with inflation. Over the last 20, decent as well at the 5% level. Remember, you are also getting a fairly attractive dividend yield, and we do note they have been increasing those dividends for the last 13 years. Now, as we said, not something we look too much to, but we will just run through this 5-year average P valuation signal. It does say reasonably valued, and ultimately it runs it through this system where when we do zoom in over the last 12 months, we have a blue bucket which essentially signals the fair value. Right now, according to this model, it is trading right at the bottom, so there is some upside according to this valuation tool. Remember, we do have our own valuation towards the end of the episode, and we also like to flag dividend yield theory, where it states a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, quite severe undervaluation. In terms of the forward P though, at 11.3, it isn't dissimilar from the 5-year rolling of 11.8, and we do note it is significantly lower than healthcare sector as a whole at 17. Remember though, we're not looking at any one of these models in isolation, and we will conclude towards the end of the episode. Now, free cash flow, always what we draw your attention to, as opposed to the earnings, which is susceptible to manipulation by management through accounting. Below 60% is what we want. Massive red flag indicator in 2023. Management paid out more in dividends than they generated in free cash flow. Not something you would have picked up by looking at the earnings payout ratio, as we can see, 89%. The positive thing to note, over the next 12 months, anticipated to come down to 73%, so no worries whatsoever. At a bare minimum, we would expect around that 3 to 4% increase moving forwards. Now, free cash flow, ultimately what we want to see from here is increases consistently over the longer term. We noticed before COVID it was fairly flat, very inconsistent with minimal movement. It then shot up in 21-22 before coming down in 2023. Good thing to note, over the next 12 months, they are anticipating some rapid growth to that free cash flow per share, so always great to see that as a shareholder. Then we look at the sales growth, where we want a 3 to 7% on a year-on-year basis. Very, very inconsistent before COVID. 2021, 2022 looking very strong, and 2023, no surprises after COVID that their revenue did drop around to negative 42%. Understandable why since then that share price has come down quite significantly. From a numerical perspective as well, we can see that total sales pretty much flat from 2014 to 2020, a sharp increase to 100 billion before coming down to 59 in 2023. As always, we do want to point out these shares outstanding. We love it when companies do share buybacks, returning excess cash to investor pockets. They've done that over the longer term, in fact buying back nearly 1 billion shares, but ultimately we do want to point out, as we did see in fact in the investor presentation, it isn't something they have a plan for in 2024. Whether they start to do this in 2025 and beyond, something we just need to see what management say. ROIC, one of my favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital. Very strong up until 2022, massive drop in 2023. No surprise again, a lot of the metrics that we have seen and will come to see have deteriorated over the last year. So again, bear that in mind, and something we will consider in essentially our margin of safety. Now, operating margin, we want to see at a minimum 12%, as well as operating efficiency increasing over the longer term. Again, looking very healthy, although inconsistent up to 2022, down to 9% in 2023, alarmingly low over the last 12 months at 6%, so definitely something we do need to keep our eye on. Free cash flow margin, very similar story, looking very strong up until 2022. It has dropped in 2023, but that is still above the minimum we want to see. Hopefully they can work their way back to what we have consistently seen from this management and from this company. We then get to the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, below 3. Remember, the numbers that you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. And why we focus on this metric correlates to both dividend safety, balance sheet strength. We want below 3. We get that every year by 2023. We see it go quite high. Positive to note, it is expected to come down to 2.66, but probably why we do get a safe dividend score instead of that very safe score that we do like to see. So not too bad, but something to keep an eye on, and we will very quickly look at their balance sheet. Now, we already looked at their top line revenue growth. As we said, very inconsistent, looked very strong during the COVID period, and over the longer term, as we can see, it is shown through the graphical perspective. That what we want to highlight here in this part of the analysis is, what does the bottom line net income tell us? Is it the same? Do we see some inconsistency growth during COVID? But from a graphical perspective, yes, very, very inconsistent. 2021, 2022 looking very good. A little bit alarming how much it drops from 2022's 31 billion down to 2 billion. So again, something to keep an eye on. Hopefully with the acquisition of Seagen, with their pipeline increasing, a lot of these moving from phase 3 into the registration, we hopefully can see this show up in both the revenue as well as the bottom line net income. But at the same time, you are also getting a near 6% yield just to sit and wait. Then we move on to the balance sheet. As we said, a quick health check, total cash versus total debt. 36 billion in 2014 of cash in the balance sheet. Over the longer term, it has started to come down, now sitting around 7 billion, so that is a massive drop. But as always, that number in isolation doesn't really tell us anything, which is why we always like to compare it numerically and directionally to total debt. And what we do note, it has increased, in fact nearly doubled from 37 billion in 2014 to around 70 billion in the latest quarterly report. So again, something we do need to keep an eye on. We did discuss this when we looked at the net debt to EBITDA ratio, but as always, there are things we do need to consider for our margin of safety. Now, in terms of earnings, how they've performed over the last 4 quarters, nice to note, 100% track record. They have outperformed analyst targets. Over the next few quarters, we do note a lot of inconsistency, but nonetheless, over the next full year, they do expect the EPS to increase, with the forward P coming down to around 10.11. On top of this, we want to look at some gradings. The first one is the valuation, where they get a D+. Now, main thing that we really want to point out, as we've already taken a look at, in comparison to the sector median, Pfizer does trade at a massive discount, in fact 50%. So right now, if you're adding this company to your portfolio, in comparison to the sector, you are receiving a 50% discount. Now, it may be warranted, it may be a very poor company in terms of other metrics, and this is something we need to understand and declare whether or not the margin of safety is sufficient for us to add to our portfolio. Pretty much any other valuation metric you use, or for the majority, it gives us the same conclusion that Pfizer is trading at that discount. In terms of growth, while they do get a D-, we can see year-on-year revenue growth, as we've already looked at, has dropped significantly. Sector median looking good at 7%. Forward looking as well, they are expecting another drop of 14%. Again, sector median significantly better and in fact positive at 8.5%. And then when we take a look at the earnings per share over the next 3 to 5 years, they're expecting 9.6% EPS growth year on year. Sector median slightly higher at 11.1%. Then we move on to the final grading, which is the profitability, where they do get an A+. Gross profit margin at 60%, marginally better than the sector of 58%. Bottom line, as we can see here, on a trailing 12-month basis, -5%. Sector as a whole, pretty much in line, but ideally we do want to see them turn a profit for the full year of 2024. And finally, one thing that we do like, massive cash from operations, $8 billion versus the sector median of -14. Now, in terms of a quick conclusion for this part of the analysis, double buy rating with the hold from quant, D+ on valuation, D- on growth with an A+ on profitability. Now, before we jump into the valuation, let's see how the performance compares against others in the pharma industry. We have Sanofi, BMY, Novartis, as well as a few very well-known others that we have covered before on this channel. Now, over the last 12 months, we do note Pfizer is the worst performing, down 11%. Remember, this is including reinvesting those dividends. When we extend it over the last 5 years, we can see again the worst performing, up only 5%. Over the last 10 years, we do note right there still towards the bottom at up 53%. Not a great return, especially if you've been reinvesting over the last 10 years. But as always, remember, past performance is not an indicator of the future. Could be a lot better. In fact, it could also be a lot worse. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $38, the way we got this is by running it through 4 different models. We have Graham's valuation with the ticker symbol, EPS, long-term growth rate and the AAA corporate bond yield, giving us a massive undervaluation signal at 44.53 versus the market price of 28.50. Bear in mind though, we're not looking at any one of these models in isolation. Then we have the multiples valuation model, average P of the companies that we just took a look at, multiplied by the EPS, giving us another massive undervaluation signal, so 2 for 2. Then we move on to the dividend discount model, as we can see the growth over the longer term. Not too great, around 3%, as we said, ideally a minimum of 4. Moving forwards, we've gone a little bit more conservative, below the average 3.14, and as we can see here, a nice undervaluation signal. And then we move to the DCF model with the free cash flow year on year. Notice that for 2024, we have used the expected free cash flow from management. We've gone for 7% in line with management expectations for the free cash flow. And by using the discount rate, we get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and as we can clearly see here, another undervaluation signal, giving it 4 for 4. Now remember, you can grab a copy of this model by clicking on the pinned comment below, where you can run your own numbers, whether it's for Pfizer or any others that you do desire. Now we're not finished there. With the intrinsic value of 37.58, we always like to use a margin of safety, and we start off with 10%, execute and buy if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe this in today's episode, it is a buy up to $34. Then we keep going till it's near the current trading price. And what we can see in today's episode, you're getting near 25% MOS, but right now sitting somewhere between the 20 to 25%. On top of that, Wall Street very bullish, $35 price target. They see upside of 21%. And remember, like we said, it isn't just a company that you are looking at in terms of upside growth, but you are also getting a near 6% dividend yield, which does increase by inflation over the last 5 to 10 years. As always though, do give us your thoughts in the comments below. Is this a company you're looking to add? Maybe in fact you were adding it when it was more towards the 52-week low. Maybe you're holding it, or for whatever reason, it doesn't fit your portfolio. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And don't forget to click on the pinned comment below where you can sign up to the free weekly newsletter, as well as joining us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.